That 1.5% fee, which sounded so small, just cost you $600,000. $600,000. That is not a rounding error. That is not pocket change. That is a fortune. That is the difference between a comfortable retirement and a luxurious one. That is your children's inheritance. That is your security and your freedom. I am going to show you how Wall Street has been quietly stealing your retirement, 1% at a time. The average American investor pays away over $600,000 in unnecessary fees over their lifetime. $600,000 that should be yours. And the worst part, most people have no idea it is happening. Today, I am going to walk you through the simple math that the financial industry does not want you to see. And I am going to give you the exact solution. I use myself a solution so simple that Wall Street has spent billions trying to convince you it cannot possibly work. But it does work. And by the end of this video, you will know exactly how to keep your money instead of handing it over to fund managers who cannot even beat the market. Hello, friends. Thank you for taking the time to sit with me today. You know, I have been thinking about something that troubles me deeply, and it has troubled me for a very long time. It is not a complicated matter. In fact, it is so simple that it almost sounds boring when I say it out loud. But this simple thing, this quiet little problem, has cost American investors trillions of dollars over the past 50 years. Trillions, with a T. I am talking about fees. Now, I know what you are thinking. Fees? That is what he wants to talk about? Fees are boring. Fees are just the small print at the bottom of a statement. Fees are the cost of doing business. Well, friends, I am here to tell you something that Wall Street does not want you to know. Those fees are not small at all. In fact, those fees might be the single biggest obstacle standing between you and financial security. Let me share a little story with you. Back in 2007, I made a bet, a public bet. I wagered $1 million that a simple, low-cost index fund would outperform a collection of hedge funds, those fancy, high-fee investment vehicles that are supposed to be run by the smartest people on Wall Street. The bet would run for 10 years, from 2008 to 2017. Now, you have to understand what I was up against. Hedge funds charge enormous fees. They typically charge what they call 2 and 20. That means 2% of your assets every single year, plus 20% of any profits they make. So if you hand them $1 million, they take $20,000 right off the top, whether they make you money or not. And if they do make you money, they take a fifth of it. The hedge fund managers I bet against were not amateurs. These were sophisticated, well-educated people. They had access to the best information, the fastest computers, and the most complex strategies. They could short stocks, use leverage, trade derivatives, and move in and out of positions in milliseconds. They claimed they could protect you when markets fell and capture gains when markets rose. They said they offered something better than the boring old stock market. I, on the other hand, chose the simplest thing imaginable. I picked a low-cost S&P 500 index fund from Vanguard. This fund does not try to beat the market. It does not have a genius manager making brilliant decisions. It just owns a piece of the 500 largest companies in America, and it charges about 0.1% per year in fees. That is it. No magic, no sophistication, no 2 and 20. So what happened over those 10 years? The index fund returned 125.8%. The 5 funds of hedge funds that were chosen to compete against me averaged just 36%. It was not even close. The simple, boring, low-cost index fund absolutely crushed the high-fee hedge funds. And the primary reason was not that the hedge fund managers were stupid. Many of them are quite intelligent. The reason was the fees. Those fees compounded year after year, eating away at returns like rust on steel. Now, I have to ask you a question. If the smartest, most sophisticated investors on Wall Street could not beat a simple index fund after fees, what makes you think your local financial advisor or that mutual fund you own is going to do it? You see, this is not about intelligence. This is not about hard work. This is about mathematics. This is about the power of compound interest working for you instead of against you. And when you pay high fees year after year, compound interest becomes your enemy instead of your friend. I want to spend our time today walking through this problem carefully. I want to show you the numbers. I want to explain why this happens. And I want to give you a simple solution that anyone can use. You do not need to be a financial genius. You do not need to spend hours studying charts and reading annual reports. You just need to understand a simple truth. In investing, you get what you do not pay for. So settle in, get comfortable, and let me tell you about the greatest scam that Wall Street has ever pulled on the American public. It is not dramatic, it is not sexy, but it is costing you a fortune. Let me start by explaining how most people think about fees. And then I will show you why that thinking is exactly what Wall Street wants. When someone tells you that a mutual fund charges 1.5% per year, that does not sound like much, does it? 1.5%. That is practically nothing. If you have $100,000 invested, that is only $1,500 a year. You might think to yourself, well, if this smart fund manager can beat the market by 3 or 4%, then paying 1.5% is worth it. That sounds reasonable, does it not? But there are 3 massive problems with this thinking. First problem, most fund managers do not beat the market. Now, I know they all claim they will. They have beautiful brochures and impressive presentations. They will show you charts of their past performance. They will tell you about their proprietary strategies and their experienced team. But here is what the data shows. Over any 10-year period, roughly 80 to 90% of actively managed funds fail to beat their benchmark index after fees. 80 to 90%, think about that. If you pick an actively managed fund, you have about a 1 in 10 chance of picking a winner. Those are not good odds. Second problem, that 1.5% is not really 1.5%. Let me explain what I mean. If the stock market returns 8% in a year and you pay 1.5% in fees, you are not giving up 1.5% of your money. You are giving up 1.5% of your 8% return. That is actually 18.75% of your gains. Almost 1/5 of everything you make goes to the fund manager. When you think about it that way, it does not sound quite so reasonable anymore, does it? Third problem, and this is the big one. Compound interest works both ways. Everyone understands that compound interest helps your money grow over time. You earn returns on your returns. But what people forget is that fees compound too. You pay fees on your fees. Every dollar you pay in fees is a dollar that cannot grow for the next 30 years. Let me give you a concrete example. Suppose you are 25 years old and you have $50,000 to invest for retirement. You are going to add $5,000 every year until you are 65. That is 40 years of investing. Let us assume the market returns 8% per year on average, which is roughly what it has done historically. Now, let us compare 2 scenarios. In scenario 1, you invest in a low-cost index fund that charges 0.04% per year. That is 0.04%, practically nothing. Over 40 years, you would end up with about $1.9 million. In scenario 2, you invest in an actively managed mutual fund that charges 1.5% per year. That is pretty typical for an active fund. Over 40 years, you would end up with about $1.3 million. Do you see what just happened? That 1.5% fee, which sounded so small, just cost you $600,000. $600,000! That is not a rounding error. That is not pocket change. That is a fortune. That is the difference between a comfortable retirement and a luxurious one. That is your children's inheritance. That is your security and your freedom. And remember, this assumes the active fund matches the market return before fees, but we already know that most of them do not. So in reality, the damage is likely even worse. Now, some of you might be thinking, well, my advisor only charges 1%. That is not so bad. Let me tell you something. 1% is still too much. In the example I just gave you, a 1% fee instead of 1.5% would save you about $200,000. That is better, but you would still be giving up about $400,000 compared to the low-cost index fund. Here is another way to think about it. Suppose you work for 40 years and you save diligently and you build up a nest egg of $1 million. Now suppose your investments charge you 1% per year in fees. That means every single year you are handing $10,000 to your fund manager. $10,000 for what? For underperforming the market? I have to tell you, friends, this makes me angry. Not in a loud, shouting way, but in a deep, quiet way. Because I see hardworking people like you, giving away their financial futures to an industry that is not earning its keep. Now, let me tell you about all the different ways Wall Street has figured out how to reach into your pocket. Because that 1.5% management fee I just talked about, that is only the beginning. You see, the financial industry has gotten very creative over the years. They have invented all sorts of fees, and they have given them complicated names so you will not pay too much attention. Let me walk you through the fee factory. First, you have the expense ratio. This is the annual fee that every mutual fund charges. It covers things like the fund manager's salary, marketing costs, administrative expenses, and so on. For actively managed funds, this typically runs between 1% and 2%. For index funds, it can be as low as 0.03%. That is a massive difference. Second, you have load fees. Some funds charge you a fee just to buy in. They call it a front-end load. So if you invest $10,000 in a fund with a 5% front-end load, only $9,500 actually gets invested. $500 goes straight to the broker who sold you the fund. Now, I have to ask, does that make any sense? You are paying someone to take your money. There are thousands of no-load funds available. There is absolutely no reason to pay a load fee ever. Some funds are sneaky and charge a back-end load instead. That means they hit you with a fee when you sell. They might call it a redemption fee or a surrender charge. It is the same thing. They are making it expensive for you to leave. That should tell you something right there. Third, you have trading costs. Even if a fund's expense ratio looks reasonable, the fund manager might be buying and selling stocks constantly. Every time they trade, there are costs. Brokerage commissions, bid-ask spreads, market impact costs. These do not show up in the expense ratio, but they absolutely come out of your returns. Studies have shown that high turnover funds can have hidden trading costs of 0.5% or more per year. Fourth, you have tax inefficiency. This one is invisible, but it is huge. When a fund manager sells stocks at a profit, those capital gains get passed on to you, the investor. You pay taxes on those gains, even if you never sold a single share. Index funds, because they trade so infrequently, are much more tax efficient. Over a lifetime of investing, the tax difference can be enormous. Fifth, if you're working with a financial advisor, you have advisory fees on top of everything else. A typical advisor charges 1% of your assets per year, so now you are paying 1% to the advisor, 1.5% to the mutual fund, and you are incurring trading costs and tax inefficiency. You could easily be giving up 2.5% or 3% per year in total costs. Friends, Let me make this very clear. A 3% annual cost is catastrophic, absolutely catastrophic. If the market returns 8% and you pay 3% in fees, you are keeping 5%. That means you are giving up 37.5% of your returns, more than 1/3 of everything you earn every single year for the rest of your life. Now, here is what really bothers me. The financial industry knows all of this. They have known it for decades. They have seen the studies. They understand the math. But instead of lowering their fees and competing on price, they have doubled down on marketing and complexity. They create fancy new products with impressive sounding names, tactical allocation funds, smart beta funds, alternative strategy funds. They promise to protect you from market crashes. They promise to find hidden opportunities. They show you complicated charts and use sophisticated language. And all of it is designed to justify charging you higher fees. I remember back in the 1990s, when the dot-com bubble was building, there were funds charging 2.5% or more, claiming they had special insight into technology stocks. People paid those fees happily because the market was going up so fast. But when the bubble burst in 2000 and 2001, those high fees did not protect anyone. The funds fell just as hard as everything else, except the investors who paid high fees were hurt twice, once by the market crash, and again by the fees they had paid during the good years. The same thing happened in 2008 during the financial crisis. All those hedge funds and sophisticated strategies, they did not save their investors. They charged their 2 and 20 right through the crash. You see, fees are like gravity. They are always pulling on you. In good markets and bad markets, in booms and busts, whether the fund manager is doing a good job or a terrible job, the fees never stop. Now, you might be wondering, if all of this is true, why does the financial industry keep charging such high fees? Why do smart people keep paying them? Let me explain how this system perpetuates itself. The first reason is incentives. The financial services industry is not paid to make you wealthy. It is paid to gather assets and generate fees. Think about that distinction. A broker earns a commission when you buy or sell. So what do you think they want you to do? Buy and sell more often. A fund manager gets paid a percentage of assets under management. So what do they want? More assets. They do not get paid extra for beating the market. They get paid for convincing you to give them your money. I always say, never ask a barber if you need a haircut. Well, never ask a commission salesperson if you need to buy an expensive financial product. The answer is always going to be yes. The second reason is complexity. The industry has figured out that if they make investing seem complicated and scary, people will pay for help. They use jargon. They talk about alpha and beta and Sharpe ratios and modern portfolio theory. They make it sound like you need a PhD in finance to invest successfully. But here is the truth. Investing is not that complicated. It can be very simple. But simple does not generate fees. I have always believed that if you cannot explain something simply, you do not understand it well enough. When someone starts throwing around complicated terminology and refuses to explain things in plain English, I get suspicious. Usually, they are either trying to confuse you or they are confused themselves. The third reason is marketing. The financial industry spends billions of dollars every year on advertising. They run commercials during football games showing happy couples on the beach enjoying retirement. They sponsor golf tournaments and symphony orchestras. They put their names on stadiums. All of this creates an image of trust and sophistication. But here's the thing. You are paying for those commercials. You are paying for that stadium. Every dollar they spend on marketing comes from the fees they charge you. The fourth reason is that people want to believe. They want to believe there is someone out there who can beat the market. someone who can protect them from crashes and find the next Amazon before everyone else. It is human nature. We want to believe in heroes and geniuses. We want to believe we can get rich quick without taking much risk. But investing does not work that way. The market is remarkably efficient. Millions of smart people are looking at the same information you are. When you buy a stock, someone else is selling it. One of you thinks it is going up, and one of you thinks it is going down. You cannot both be right. And after decades of watching this game, I can tell you, very few people can consistently outsmart the market. And the ones who can, they are not managing your mutual fund for 1.5% a year. They are either managing their own money or charging the really big fees at exclusive hedge funds. The fifth reason, and this one is important, is that the underperformance happens slowly. It is not dramatic. You do not wake up one morning and discover your fund manager stole half your money. Instead, you earn 7% when you could have earned 8.5%. The difference seems small in any given year, but over 20 or 30 years, that small difference becomes a canyon. It is like termites eating your house. You do not notice the damage day by day, but over time, the structure weakens. And by the time you realize what has happened, the damage is done. I want you to understand something. I am not saying everyone in the financial industry is dishonest. Most of the people working in this business are good people trying to make a living. But the system itself is designed to extract fees, not to maximize your returns. And until investors wake up and demand better, nothing is going to change. You know what the most frustrating part is? The solution is so simple. It has been sitting right there in front of everyone for 50 years. Jack Bogle figured it out when he created the first index fund in 1975. Buy the whole market, keep costs low, hold for the long term. That is it. That is the secret. But Wall Street does not want you to know that. Because if everyone figured out how simple good investing really is, a whole lot of people would be out of a job. Let me take you back in time for a moment. Because this problem is not new. People have been speculating and gambling with other people's money for centuries. And the pattern is always the same. Back in the 1920s, just before the Great Depression, there was a boom in something called investment trusts. These were the mutual funds of their day. Promoters would set up a trust, convince people to invest, and charge hefty fees for their expertise. They promised sophisticated professional management. Sound familiar? What happened? Well, when the market crashed in 1929, these investment trusts got absolutely decimated. Many of them used leverage, which magnified the losses. The fees did not protect anyone. The expertise did not save anyone. Investors lost everything while the promoters had already taken their fees off the top. Or consider the 1960s and 70s. That was the era of the go-go fund managers. Young, aggressive managers who traded constantly and claimed they could outperform the market through superior stock picking. These funds had expense ratios of 2% or more, plus heavy trading costs. There were magazine covers and television interviews. Everyone wanted to find the next superstar manager. What happened to those superstars? Almost all of them eventually crashed. The ones who did well for a few years inevitably had terrible years that wiped out the gains. And the investors who chased performance, jumping from one hot fund to another, did even worse because they were always buying high and selling low and paying fees the entire time. Then came the 1990s and the technology bubble. Oh, the 1990s were something special. Technology funds were charging 2%, 3%, even higher. And people paid happily because those funds were going up 20, 30, 40% a year. Everyone thought the old rules did not apply anymore. This was the new economy. The internet changed everything, except it did not. When the bubble burst in 2000, those technology funds fell 70, 80, 90%. And again, The fees did not provide any protection. In fact, the funds with the highest fees often took the biggest risks and suffered the worst losses. Here is what I learned from watching all of this. Speculation is always the same. The details change: railroads in the 1800s, radio stocks in the 1920s, technology in the 1990s, cryptocurrency today, but the pattern never changes. People get excited, prices go up, promoters charge high fees, and eventually reality sets in. But there is one group that makes money in every bubble and every crash. Can you guess who? The financial intermediaries, the brokers, the fund managers, the advisors. They get their fees whether you win or lose. Now, let me contrast that with a different approach. In 1976, a man named Jack Bogle launched the first index investment trust, which later became the Vanguard 500 index fund. The idea was radical at the time. Just buy all 500 stocks in the S&P 500 and hold them. No genius manager, no complicated strategy, just own the market. The financial establishment hated it. They called it un-American. They said settling for average returns was foolish. One critic called it Bogle's folly. After all, if everyone just bought the index, who would pick the good stocks from the bad ones? But Bogle understood something crucial. He understood that in the aggregate, investors as a group must earn the market return minus costs. That is just arithmetic. If some investors beat the market, others must lose to it. It is a zero-sum game before costs and a negative-sum game after costs. So the question is not whether you can beat the market. The question is whether you can beat the market by enough to justify the costs of trying. And the data shows that very few people can. Over time, the low-cost index fund beats the vast majority of active managers. Not because index investing is magical, simply because it avoids the drag of high fees. Today, Vanguard manages over $8 trillion. $8 trillion. Jack Bogle, who passed away in 2019, probably saved investors more money than anyone else in history. Not by making brilliant stock picks, not by timing the market, simply by cutting fees to the bone and letting investors keep more of their own returns. I had the privilege of knowing Jack. We did not agree on everything, but I respected him enormously. He had integrity. He put investors first, and he proved beyond any doubt that low costs are the most reliable predictor of long-term success. So now you are probably asking yourself, what should I do? How do I protect myself from these fees? How do I invest wisely without getting taken advantage of? The answer is beautifully simple. So simple that it almost feels like it cannot be right. But I assure you, it is. Here is what you do. Buy a low-cost, broad-based index fund and hold it forever. That is it. That is the whole strategy. I know it sounds too easy, but let me explain why it works. First, you eliminate the management fee problem. A good S&P 500 index fund from Vanguard or Fidelity charges about 0.03 to 0.04% per year. That is $3 or $4 per year for every $10,000 you invest. Compare that to the $1,500 you would pay for an actively managed fund charging 1.5%. You just save 98 to 99% on fees. Second, you eliminate the stock picking risk. When you own an index fund, you own a piece of the entire market. You are not betting on individual companies. You are betting on American business as a whole. And over the long term, American business has been a spectacular bet. Despite wars, recessions, pandemics, political turmoil, and every kind of crisis imaginable, the stock market has gone up over time. Not in a straight line, mind you, but over any 20 or 30-year period, it has delivered solid returns. Third, you get automatic diversification. The S&P 500 includes companies from every major sector of the economy. Technology, healthcare, financials, consumer goods, energy, and so on. When one sector struggles, another often thrives. You do not have to worry about being too concentrated in one area. Fourth, you get tax efficiency. Because index funds trade very little, they generate very few taxable capital gains. More of your money stays invested and compounds over time. Now, some people will tell you this is too boring. They will say you should be more aggressive when you are young or more conservative when you are old. They will talk about rebalancing and asset allocation and international exposure. And you know what? Some of that advice is fine. If you want to add a bond fund as you get older, that is reasonable. If you want some international exposure, you can buy a total international index fund. These are minor variations that might make sense for your situation. But the core principle remains the same. Keep costs low, diversify broadly, and hold for the long term. I have told people for years that when I die, the instructions for the trust that will benefit my wife are simple. Put 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. That is it. No hedge funds, no private equity, no complicated strategies. Just low-cost index funds. Why? Because I know that over time, this approach will beat almost everything else after costs. It is not exciting. It will not make for good cocktail party conversation, but it will work. Now, I want to be clear about something. I am not saying you should never pay for financial advice. If you need help with tax planning or estate planning or thinking through complex financial decisions, a good advisor can be worth their fee, but you should pay for that advice directly, not through high investment fees. Look for fee-only advisors who charge by the hour or charge a flat annual fee. Do not pay someone a percentage of your assets every year just to put you in expensive mutual funds. And please, please, do not pay for active management unless that manager has a long track record of beating the market after fees. And even then, be skeptical. Past performance does not guarantee future results. The manager might have just gotten lucky, or the market conditions that favored their strategy might have changed. I have been investing for over 70 years now. I have seen every kind of strategy and every kind of market. And I can tell you with complete confidence, the simple approach works. Low costs, broad diversification, long-term patience. That is the winning formula. You do not need to be a genius. You do not need to watch CNBC every day. You do not need to read analyst reports or attend investment seminars. You just need to understand a few basic principles and have the discipline to stick with them. Let me leave you with a few final thoughts before we close. The first thing I want you to do when this video ends is look at your own investments. Pull out your statements. Find out what you are paying in fees. Look at the expense ratios on your mutual funds. Add up what you are paying your advisor. Calculate the total cost as a percentage of your assets. Be honest with yourself about what you are getting for that money. If you are paying more than 0.5% per year in total costs, you need to ask yourself why. What are you getting for that extra money? Is your portfolio beating a simple index fund after fees? If not, why are you paying for underperformance? The second thing I want you to understand is that this is your money. You worked for it. You saved it. You have every right to keep as much of it as possible. Do not let anyone make you feel guilty for wanting to minimize fees. The financial industry has somehow convinced people that being cost-conscious is cheap or unsophisticated. That is nonsense. Being cost-conscious is smart. It is rational. It is exactly what you should be doing. When I buy a car or a house or a piece of equipment for my business, I care about the price. I want to get good value. Investing should be no different. In fact, with investing, cost is even more important because it compounds over time. The third thing is this: do not let perfection be the enemy of good. You do not need to time the market perfectly. You do not need to find the absolute best investment. You just need to avoid the big mistakes. And the biggest mistake most people make is paying too much in fees. If you take nothing else from this conversation, remember this: in investing, costs matter. They matter more than almost anything else, more than the specific funds you choose, more than the exact allocation between stocks and bonds, more than trying to time the market. Keep your costs low, and you are already ahead of 90% of investors. I have said many times that my favorite holding period is forever. When you buy a low-cost index fund, you can truly hold it forever. You do not need to worry about the fund manager retiring or the strategy going out of favor. You are simply owning a piece of American business, and as long as America continues to innovate and grow, your investment should do fine. Now, will there be bad years? Absolutely. Will there be crashes and corrections and bear markets? Of course. The market went down 50% during the financial crisis. It dropped 34% in a single month in 2020. These things happen. But if you have a long time horizon and you do not need the money right away, you can ride out those storms. In fact, those storms are opportunities to buy more at lower prices. The key is to not panic. Do not sell when things get scary. Do not try to get clever and move to cash because you think the market is too high. Just keep buying regularly, keep your costs low, and let time work in your favor. I am 94 years old now. I have lived through World War II, the Korean War, the Vietnam War, multiple recessions, the Cold War, the dot-com crash, the financial crisis, and the global pandemic. Through all of that, American business kept chugging along. It adapted, it innovated, it grew. And investors who stayed the course did very well. I believe deeply in this country and in the companies that make up our economy. I believe that over time, owning a diversified portfolio of American businesses at a low cost is one of the best investments you can make. So my final advice to you is simple. Stop paying these fees. Stop enriching Wall Street at your own expense. Take control of your financial future. Buy low-cost index funds. Hold them for the long term. And spend your time and energy on the things that really matter in life: your family, your friends, your work, your community. Investing does not have to be complicated. It does not have to be stressful. It does not have to consume your life. It can be simple, peaceful, and profitable if you just follow a few basic principles. Thank you for listening to an old man ramble on about fees and costs. I hope this has been helpful. I hope it saves you money. And I hope it gives you confidence that you can handle your own investments without paying someone else a fortune to do it for you. Be patient. Be disciplined. Keep your costs low. And I think you will do just fine. Take care of yourselves, friends.